Any monkey can beat the market, claimed an article in Forbes in 2012. The publisher quoted findings from a report of research affiliates. The company, Research Affiliates, randomly selected 100 portfolios containing 30 stocks from a 1000 stock universe. The quirkiness here was that the portfolios were selected by monkeys. You heard that right. The process replicated 100 monkeys throwing darts at the stock pages each year. They repeated this process every year from 1964 to 2010 and tracked the results. Amazingly, on average, 98 of the 100 monkey portfolios beat the 1000 stock capitalization weighted stock universe each year. Now, why all this monkey business, you would ask? Well, it all started in 1973 when Princeton University professor Burton Malkiel claimed in his best-selling book, A Random Walk Down Wall Street, that a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. Research affiliates in turn claimed that the monkeys in fact would do a better job than experts in the stock market. It's this kind of story that investors love because it makes the stock market sound like a glorified casino where luck and not skill separates winners from the rest. Unfortunately, similar trend seems to have emerged when it comes to investing in new stock listings, which is IPOs, stocks of companies reporting very high total addressable market, companies proclaiming monopoly status, and companies in new emerging sectors in India. For instance, in the run-up to an entity's public listing or IPO, ideally profitability should be the most closely watched number. It is the profitability metric that is supposed to give investors the confidence to buy the stock at a reasonable valuation at its IPO. But there is a particular trend now emerging for most new age companies where the financials show sudden profits in the most recent quarter before the filing of IPO documents. It has become a common practice for startups to show profitability for just a quarter or two before the IPO. All thanks to the last minute other income and accounting adjustments. Be it Grow, Lenskart, Urban Company, Pine Labs, or any other high profile IPO in recent months, the story of sudden profitability seems common. Of course, the accounting adjustments are within the Indian accounting standards, they are disclosed in IPO documents, they are signed by auditors and merchant bankers. Therefore, they do not attract any regulatory embargo. But that does not hide the fact that such profits are unsustainable at best and imaginary at worst. For retail investors, the biggest challenge is distinguishing between a real turnaround and a financial facelift. One-off items such as asset sales, fair value adjustments, or accounting gains can make the companies look profitable temporarily. The IPO valuations are unfortunately based on the most recent EPS. So the IPOs espouse imaginary profits only. But let's not blame the IPOs alone. Yes, the profits are temporary. Yes, investors still fall head over heels to pay multiples that are hundreds of times the reported profits to speculate on the listing gains. But that is entirely the investor's decision. There are also cases of listed stocks where the entity claims to have growth prospects that defy logic. They make the practice of studying historical trends seem stupid. For instance, IRFC is the key funding arm of the Indian Railways. It borrows funds from the financial markets to finance the acquisition or creation of assets which are then leased to the Indian Railways. Thanks to the government guarantee, the company, which is a financing entity, neither provides for nor reports any non-performing loans. As compared to any other NBFC, the company has a skeletal team for the processing of the leases. It also pays very low taxes. Understandably, the company fetches almost 99% operating margins. The optical illusion of the monopolistic nature of this business has helped the stock fetch premium valuations since listing. But what goes ignored is that the entity's debtor days is upwards of 3,800 days. In other words, if NPAs were to be recorded or provided for, the company could struggle to exist. Then there are entities like LMW, which was earlier called Lakshmi Machine Works, that have cashed in on their near monopoly status. LMW technically has monopoly in the manufacturing and selling of textile spinning machinery, CNC machine tools, heavy castings, etc. Although the company has invested in capacity expansion, technology upgrades, and the modernization of its manufacturing processes to meet customer demands, profits have been scarce over the past decade. But even the low single digit operating margins and return ratios of the business have not kept investors away from the stock. The possibility of using its precision manufacturing skills for segments like defense has kept the valuations of the stock perched at double and triple digit multiples. In fact, the stock has gone up 6 times in the past 5 years. So it is not just IPOs that are espousing imaginary profits. Rather, the belief that the monkey-like dart-throwing strategy is going to yield fantastic results is so ingrained in investor mindsets, especially during bull markets, that only a sharp correction can show the real picture. Until then, as they say, caveat emptor or buyer beware. Hope you like this video. Thanks for watching.